Hello, welcome to this week's Market Carver. I'm Andrew Thrasher, Portfolio Manager for Financial Enhancement Group. I'm joined this week by Zach Unger, Senior Analyst. We have two really important topics to talk about this week. We're going to look at how assets have been performing and kind of dicing up how we're looking at performance since August. And Zach's going to dive into the latest GDP report and discuss the implications that we've had with the tariffs that have kind of been a topic all year long. First, I want to show you the first chart we have here. This is looking at the asset performance since August. If we zoom in on this, we can see that it's kind of a different type of grouping. First, we can see on the far right side that the S&P 500 since August, the start of August, is up about 4%. If we look at all the other stocks outside of those Mag 7, if you've watched the Market Carver for any period of time, you've heard us talk a lot about the Mag 7, those 7 largest stocks: NVIDIA, Microsoft, Apple, Google, all those big guys up there. If we back those out, we see that most other stocks performed about in line, 3%. Mag 7 was up 7%. What's interesting about this data is the huge focus that we've had the market been putting on is quantum computing, think AI, a lot of the stuff going on in that universe, and a lot of it was attributable to a big announcement that Oracle made where they were going to start investing $60 billion a year into OpenAI. If you think of OpenAI, think ChatGPT, one of the big AI platforms out there. We saw Oracle stock have a huge jump, one of its largest in its trading history, of 25% off this announcement. Why it's important was a really good letter that came out of JP Morgan and showed that for the $60 billion a year, the market got really excited about it. But you have to look at what was actually happening there. What they found was that they were getting a kind of a deal with OpenAI, with ChatGPT, to provide the cloud computing for Oracle in their data set, in their data facilities that hadn't even been built yet, that actually requires so much power, over 4 gigawatts of power, the equivalent over two Hoover Dams worth of power, and increase their borrowing, their debt to equity ratio to over 500%. Why this is important and why we're focusing on it on the allocation team is we're seeing these grandiose announcements, anything that can be attached to AI that has such massive implications on the day, but the actual implementation is much more difficult. We saw a lot of this happen back during the blockchain of 2017, where any type of stock that was talking about crypto or blockchain, we saw their stock explode. We saw this happen back during the tech wreck, where any company that added .com to their name saw a massive spike higher in their stock price, where we get these exuberant, almost bubble-like themes, and the market starts to go crazy for them. Why this is important, and we can see the performance of this type of stock is up over 60% compared to the overall market only up 4%, is the market's getting a little bit too excited, we feel, for this theme. Now, that doesn't necessarily mean that we're seeing a bubble that's popping or that we're going to see an end to the tech leadership, but we are seeing the market get a little bit ahead of its skis, so to speak, and really kind of, I think, overemphasizing some of the headlines that we're seeing around the AI space. Now, we do believe AI has massive implications. We've had a lot of discussions about how this is impacting different sectors and different markets and the longevity that those can have. But we are seeing from a stock performance in the short term, we are thinking that things are getting a little bit stretched in that theme, in that space, relative to the Mag 7 leadership or the S&P 500, or really just any other stock that's a large cap stock in the US and how it's being traded. And so we think it's important to recognize, while these headlines garner a lot of views, it's a topic, if you came to the third leaf, that Joe spends a lot of time talking about, that we don't want to put an overemphasis on a single theme or a single topic, because we do want to stay longer term focused and recognize that this can draw in some volatility. As stocks really see a big run, they can then ultimately possibly have a pullback. So we've seen a strong performance since August in this space. It's something that we're not necessarily wanting to chase in the short term, but do believe that AI has implications going forward. It's just the performance over the last couple months is a little bit too exuberant for us. And it's something we definitely want to keep an eye on, and how those stocks perform going forward. Now I'm going to shift it over to Zach. We're going to go take it from the market, go back over to the economy and the implications of tariffs. Zach.
Yeah, so we did get second quarter GDP numbers recently. Came in at 3.8%. Q1 was at negative 0.6%. And what we often like to do with these headline economic numbers or kind of market related themes is we like to take a look under the hood and understand what's driving the trend, Why is it 3.8? What contributed to that? And then maybe how can that impact what the markets and the economy may do moving forward, and how can we position ourselves accordingly? So you see the chart on the screen there, the quarterly GDP over the past 3 years or so. You'll notice that 3.8% is the largest, or the strongest rather, quarterly growth that we've had since about the middle of 2023. The pieces under the hood that really stand out in terms of what's driving that high growth number: one, business investment in AI. Much like Andrew was talking about, we have over quadrupled the business investment in AI since 2020. And so business investment, particularly in AI and the equipment and the software that's involved with that, has certainly driven GDP upward. The notable point, especially as it relates to tariffs, is the front loading of imports in Q1. Net exports, which is your exports minus imports, is one of the key contributors to GDP. And so when tariffs were announced, we saw lots and lots of companies front load their inventory, meaning that they imported a significant amount in order to get ahead of the tariffs and what they anticipated being higher costs for some of the goods that they were importing. Well, because they imported so much in Q1, they had much less to import in Q2, and we did see those numbers come back down, which is a boost for GDP. And so some of what you're seeing in this large disparity between Q1 and Q2 GDP is the impact that tariffs had on importing and exporting, and how that flows through into the actual GDP calculation. The other thing that I think is interesting to note here as an input to GDP is PCE, or personal consumption expenditure. It's the Fed's preferred gauge for inflation, helps us get a read on the American consumer. An interesting tidbit about how the consumer is performing: we did see relatively stable consumer performance, meaning that people are still spending money, but the underlying demographic of how the consumer is spending and which consumer is spending is starting to shift a little bit. We're now seeing the top 10% income earners are really the ones driving consumption, rather than a broadening out of the entire American consumer across the income spectrum. So lots and lots of inputs that come into this. The disparity in the Q1 and Q2 numbers, quite stark, but when you look under the hood, it starts to make a little bit more sense. With the Fed starting to cut rates, there's some uncertainty in the labor market. Still not entirely sure what the impact of tariffs is going to be long-term on the economy. So there are a lot of things that we're still waiting to see how they play out. Certainly several different directions that this can go, but thought it would be helpful to just provide some context to that GDP number.
Thanks, Zach. And that's a great point. As we close out September, we close out Q3, and we'll start hearing more about the impacts of those tariffs and the implications they have going forward as we start digging into the earnings calls and announcements as companies begin to report Q3 numbers in the coming weeks and months. Thank you so much for joining us this week on the Market Carver. If you have any questions or like to schedule an appointment, please do so with the phone number on your screen, the QR code, or learn more about us at the website on your screen right now. Thank you so much, and we'll be back next week with some more topics on the Market Carver. Thank you.